Hey, in today's video, we're going over the tax planning decision. At retirement, you've got a decision on tax planning. And so there's actually 10 key decisions. We wrote a new book, Your First Federal Retirement, the 10 decisions that could make or break your retirement. So make sure you get a copy of this. But the tax planning decision is a key one. My name is Mel Stubbs. I'm a financial planner at Christy Capital Management. And in today's video, I've got Joe Matthews and Tommy Neesmith alongside. We're going to talk over the tax planning decision, so stick around. So the decision number 5 is the tax planning decision. We talk about asset allocation a lot, how aggressive, how conservative. Well, for a second, let's talk about asset location. There are 3 different type of accounts and how they're taxed. The first one is tax deferred. This is your traditional TSP, traditional IRAs. This is your paycheck that you chose not to accept. You put it there, it's growing, and now when you take a distribution, it is taxed like your paycheck. It's taxed at your tax bracket. The next one is taxable. These are just a regular old like brokerage account or a savings account, CD. Depending on what it is, it's got growth. You got to pay taxes on that growth. For like CDs and savings accounts, you got to pay taxes each year. You don't get to defer or anything. It's taxable each year at your tax bracket. If you've got a brokerage account and you've got like long-term capital gains, those type of things, it's taxed at capital gains rates, which is a little bit better, but it's still taxable. So as you have growth and you have a transaction, it is taxable. The last one, I think we'd agree it'd be the best one, just to make compliance happy. It's best. It depends on how much you got to pay to get to it. We'll agree tax-free is better, but you got to pay a cost to get there. We're going to talk about that. So depending on what the cost is for you, it can be better. But with tax-free, you put money in, you go ahead and pay the tax now, you put it in Roth. Whether it's Roth TSP or Roth IRA, it's after taxes. All the growth is tax-free. All the distributions are tax-free as long as you've had the account for 5 years and you're 59 and a half. And it's kind of tax-free for you in your lifetime. If you leave it to a beneficiary, it's tax-free to them in their lifetime. So as far as features, it's better. The problem is there's a cost of admission. You got to pay taxes now to get it there.
Well, and I think that's important, Mel, Joe, as you talk about that cost of admissions. It's always going to cost to get there, right? The thing that you know now is what the cost is. And so the question you really have to sit down and ask yourself is, do you believe taxes are going to be higher or lower in the future? And when we talk about the future, we may be talking 15, 20, 30 years from now. And so history tells us that taxes typically increase over time. Now, sometimes they do go down. But the question is, are you willing to take that chance with it? And do you want to pay higher taxes in the future? And no one's ever said, yes, sign me up to pay higher taxes. And so as you look at this, sitting down with a professional, making sure that you plan through those taxable decisions, you're either going to pay taxes now or you're going to pay taxes later. And you've got to figure out which one you want to do. And so, Mel, give us a couple examples of how this looks.
So the way I think of it is how much it's yours. Let's say you have $100,000 in a traditional account, a taxable account, and a Roth account. How much of it is yours? So here's an example of a taxable account. You got $100,000 there. Let's just say that all the $100,000 is all growth. I don't know how that would exactly work, but let's just say it's all growth. About 85% of it would be yours if it's long-term gains. About 15% of it would be for taxes. Now with capital gains rates, there's 0% tax, 15, and 20. Seems like most of the people we're working with, they'd be in the 15% range. And so of that, 15% of it would be taxable. 85% would be yours. That's with a taxable account.
And as we talk about these taxes, we're just looking at the federal taxes, right? Yeah. And so all we're looking at are federal taxes. And so depending on what state you live in, there could be some applicable state taxes as well. But just for simplicity and clarity in the example, we're just going to talk about federal taxes.
Yeah, for capital gains, for sure, only federal. Here's an example of TSP or IRA. You've got $100,000 there. How much is yours? Well, let's just say you're in the 22% federal tax bracket and 5% state tax bracket. About $27,000 of that's going to be for taxes. $72,000 is yours. Now, the problem is when we're talking to some people, they look and go, I have $100,000. I'm just saying it looks like you have $100,000, but based on today's tax rates, you have about $72,000. $27,000 would be going for taxes. And so the dilemma is that's today's rates. If they get worse and the 27% gets bigger, just the way math works, that means your portion is getting smaller if taxes go up.
Yeah, that's good, Mel. Thanks. And then, kind of the scenario that we really like to talk about is, what if I had $100,000 in a Roth account and I met the eligibility of 59.5 and 5 years? And so if I have $100,000 in a Roth account and I get ready to take out money, I pay 0 taxes. I have 100% of my money, including the growth, available to me and my loved ones and anyone else who wants or needs it. And so that's a great thing. And so what that really means is the partnership that you have with the IRS is over.
And isn't it a lot easier to plan when you know exactly how much money you have? You're not guessing on what the tax portion is. With Roth, you can do that.
Yeah, that's good. So in regards to taxes, some accounts are better than others. This is why planning can make a difference. If all buckets are not the same, then it makes a difference where you invest your money. Make sure you're investing your money accordingly, not just looking at risk level, but also looking at the taxation.
Yeah, and let's look at, if you don't do tax planning and your traditional balance just keeps growing, let's kind of look and see what it looks like here. You'll see here 2025 to about 2035 or so. You can see on the left side of this picture, income is lower. On the right side, income is a lot higher. Well, what happened? Required minimum distributions is what happened. This example, the person hit the RMD age, and you can see how the income just skyrockets. It's a lot higher.
And you talk about that, I'll interrupt you just for a second. You talk about required minimum distributions, or RMDs. It used to be fairly simple to kind of calculate that, right? There was one age and this is when it happened. And several years ago, there was a law change, and then there was another law change. And so now we're looking at really 2 main ages to kind of look at that RMD age. And if you were born in the year 1960 or greater, then your RMD age is age 75. And if you were born before 1960, your RMD age is 73. And so as we talk about RMDs or required minimum distributions, you just determine when you were born. And probably for most folks we're talking to, it's going to be either 73 or 75.
Yeah, and the RMDs can really affect your tax bracket. And so if you look here on these early years, they're in the 22% bracket. Then it gets bumped up with RMDs. They're in the 24% and going up to the 32% bracket. And then if one of the spouses dies, your remaining spouse is now going to be on the single tax bracket. They're up into 35, 37%. So taxes don't even have to get worse for them to get worse. As your income raises, it can get worse for you.
Yeah, that's good. And that's a good example. And, I think making sure that you have control over that, you're working on that. The name of the game is controlling what can be controlled. And the great news is, with proactive tax planning, you can control the amount of your RMD before they begin. And that's where I think the value of coming alongside a fiduciary who can look through that, work through that with you, and make sure that you're maximizing your dollars.
Yeah, so let's have some action items. We got to give you some action items that you can jump on. What is your current tax bracket? That is something, as we were working with people, we want to figure that out. You should figure it out for yourself. What's your current tax bracket? What is your income? As you look at next year's income, what do you think it'll be? How much money do you have in the different types of accounts? Like how much traditional, how much taxable, how much Roth? And then how many years do you have left where you can start to shift money from the traditional to the Roth? For most people, you can't do it all at once. It's going to take a while to do it, but it is something that you want to get ahead of before you show up at RMD age.
Yeah, that's good, Mel. And last thing I'll add on that is, oftentimes, we'll hear from people going, it's too late to start doing this. I wish I had done this years ago when I first started saving, when I first started working. And it's never too late, right? Some money in a tax-free bucket growing is better than no money in a tax-free bucket. And so it's not too late for you. If you think it is, hey, give us a call. Fill out the form online. We'd be happy to talk to you and show you some ways that we can help maximize your tax planning in your retirement by utilizing some tax planning tools and techniques that have proven to work for hundreds of our clients over the past several years.
Yeah, and some people say, well, I'm not going to live that long. If I'm older, I'm not going to live that long. What does it matter? Well, it matters to you while you're living, but it also matters to your beneficiary. If you leave them traditional money, you are leaving them the tax issue to have to deal with. And with the now only 10 years to work on it for an inherited IRA, it could be a problem. So you can fix the issue by doing the tax planning while you're living. You're also fixing it for your beneficiary in that case as well.
And Mel, I'll just point out there, a lot of the beneficiaries of receiving this money at your death, a lot of them will be at the age where they're at the pinnacle of their career, and they may be making some pretty nice dollars there, and they're kind of high in the tax bracket. To have a traditional IRA or TSP money or tax deferred money come to them at that time could really soar them to the top of the bracket. So,
Absolutely.
yeah.
Hey, well, there you have it. I hope that discussion on that decision was helpful. It comes from our new book going over the 10 decisions you have to make at retirement. It's available on Amazon. There should be a little QR code here. Make sure if you want to go more in detail, you want to reach out and get it, make sure you do so. If you need individualized help, you want to talk to us, feel free to do so. Right up here, there's going to be another video that's important to your planning, so make sure you check it out.